Ladies and gentlemen, good afternoon. This is Christopher Aaron. It is the 28th of September 2016. And in this video, we are going to focus a little bit more closely in on the action in gold and silver bullion as a primary focus. We have looked at a lot of other things going on in the economy over the last several weeks. So let's take a close look at gold and silver in this video for this week. I thank you for being with me. Looking over the last 3 days, gold came off of that most recent high. You can see the approaching of the 1345, 1350 resistance level, which has served in a downward sloping trajectory for the better part of the summer, basically since the June 24th Brexit vote. And we have come off of that again, finding some short-term support here in the region above 1315. If this holds, this looks like a higher low that is forming, getting ready for a breakout that I am looking at. Looking at silver, it had been weaker than gold over the last several days, showing a little bit of relative strength today, as in closing above yesterday's high. So something that subscribers of mine are very well aware of. We follow the gold to silver ratio quite closely. It often can give us clues as to when the prices of the metals are going to be moving. So this is something that I'm looking at right now, the possibility of the gold to silver ratio moving significantly lower, perhaps into the low 60s as an initial target, where currently today we are closed at 69 for the number of ounces of silver required to purchase 1 ounce of gold. Of course, this should be moving a whole lot lower over the course of the next decade, but not yet. Now, the reason that we are focused so intensely on the prices of the metals at this juncture, and to be honest with you, there will come a point a little bit later on in this bull market where I do not think it will serve our benefit to focus on the day-to-day action quite so closely. But at this point, it does. And this is the reason. If you are new to this, just a brief backdrop on what has happened with gold here. Over the last generation and some odd years, gold made this high in 1980, right around $850 an ounce, and spent 28 years consolidating below that level, having a brief breakout above it before failing to hold it in the crash of 2008, and then making a legitimate breakout here in late 2009. Since that breakout, gold advanced for 2 years before coming back to retest that breakout almost perfectly. And you now have the price of gold that is bumping against this very directly observable downtrend line here, shown in the magenta color, which dates back from the all-time high just above 1900. Now, a couple of major points here, and this goes for almost any market that you may be observing. Number one, markets that undergo these multi-decade consolidations, 28, 29 years below a certain price point, and then break out decisively, do not finish the entirety of their advances in simply 2 years worth of time. In other words, a 28-year consolidation should be followed by an advance of a number of additional years. So what we have seen here is this advance followed by a coming back down to that breakout point and a successful retest last December. Those people who follow the macro side of things of my analysis, you know that we've been pinpointing that first Fed rate hike last December as basically marking the exact low, plus or minus a couple of days here, in this 5-year bear market. So the macro backdrop, looking at a central bank that is going to be increasing interest rates very slowly, but it looks like surely over the course of the next several years, this is going to be very conducive for the advance in gold that we are anticipating. So just looking at this line here again, why am I focused so much on this line? You don't have these linear downtrend lines that break every day in markets from an all-time high, and these tend to represent significant turning points in the market. Let's look at another example, a shorter term example, but the best example that we have. We're going to zoom in on this period right here that I'm circling with my mouse, this high near 1,000, and then the crash into 2008, and let's look at what happened at that period. So you can see this advance here right above 1,000, and then coming back into the fall of 2008 to just below 700. And notice this correction, if you will, although it was rather extreme. I was investing during this time period. I remember this very distinctly. I was very focused on the day-to-day action. I took a lot of notes during this time period, and this is, I believe, why I feel prepared for what is going to happen this time. You see this from the technical standpoint, this downtrend here, very directly observable linear downtrend from an all-time high at that time. And notice there were 1, 2, 3, 4 direct hits on this line, including, and this is a weekly chart, mind you, but including several intraday hits here, intraday hits even, multiple times that the price hit this line throughout the course of a 24-hour period. And I remember distinctly reading analysis at that time saying that, here, even at the end of the 4th hit, nope, gold is still in a downtrend. There's no interest in it. Don't buy gold yet. Don't buy gold yet. And so I was studying this time period very distinctly. There were many people advising people to wait until this downtrend is broken. And what happened after the downtrend was broken from an all-time high? You had over a doubling. Here was that downtrend. You had over a doubling of the price in the next 2.5 years, a tripling almost if you take the absolute bear market lows, close to a double from these highs. So this is the reason why I focus on these lines here. These lines represent a trend of sellers, and when these lines break, they represent a shifting of the trend, an exhaustion of the sellers, and all else being equal, a market that is then tipped over into the hands of the buyers. So that's what's happening fundamentally, psychologically behind all the players involved here. Keep this line in mind and the breakout we saw when we look at the gold market again right now. Here was that long-term magenta line. We've been focused on this for months now. If you include the pre-exit spike, which came in a little bit lower, there were 1, 2, 3, 4, 5, almost 6 hits within about a $20 range. Now, technical analysis is not about getting things down to the exact cent of a specific line. It's about getting things to a trend, understanding what the trends are, and seeing if we can determine what the markets are gearing up for based on an observation of the major trends. So we can see some of these hits on this downtrend line did not exactly hit the line. Some crossed briefly over it before coming back down. This most recent attempt here at about 13.45 or so, coming about $10 to $15 below the line. We see the price of gold is now meeting with this uptrend that has formed since December. So this trend must be respected. And we also have the very strong support here that is labeled as an initial support zone. But this support zone has held the price of gold higher for the last 3.5 months after breaking out of this on the Brexit vote day. So you have literally this convergence of trend lines here. You have multiple attempts to break above this trend line. I expect that what is going to happen to the price of gold is going to be similar when this trend line breaks compared to when that trend line broke in 2008 that we just looked at. So keep in mind, we have some anecdotal evidence. You know, as someone who publishes articles in this industry and produces research, I have a perspective on it based on, for example, the number of reads that are reported on certain articles or the number of hits that come in onto websites, et cetera, et cetera. So you can see that this consolidation, this grinding consolidation, is not only wearing people out as far as price, but it's really wearing people out as far as interest in the gold market sector. And if there's one thing I could say, it's try to place your own feelings within the context of the market's feelings. If you yourself feel like you are getting worn out at this point, that may just be how the sum of investors are feeling as human beings, as investors. And when the sum reaches a critical point of getting worn out or washed out of the market, that is typically the point at which a major move is about to manifest, because it's then the next group of buyers and sellers that enter the market after these lengthy consolidations that are going to set the trend in one way or another. I have a lot of other confirming indicators that I look at that are hinting that this break should be coming to the upside. It has not yet happened. This is why we are watching very closely. I should have brought my little key up there. I'll keep that up as we look at the silver market. Basically, silver is exceeding gold's price performance on the upswings, and it is performing inferiorly on the downswings at this point. It's kind of exactly what we should expect for silver. You even see that across the silver equities on these moves down in silver. The silver equities are underperforming. On the moves up, the silver equities are outperforming. So silver right now basically is waiting to get some direction from gold. And then when it gets some direction from gold, I expect that it is going to move in an even higher percentage term in the direction that gold moves in. So there's a lot of lines on this chart, a lot of things going on right now. The important points to remember are that this advance that we have seen from 1365 up to 2125 is the primary advance, and we have seen basically a $2.25 or so correction from the most recent high. So that's about a 10% correction when you put it in percentage terms, but notice how the sentiment has changed. From this high, 10% lower several months later, a lot of interest has been bled out of this market, and that's exactly what should happen to set up the next leg higher. So if you are still following, if you're just becoming interested at this point, I would say to you that you are probably working on some independent level against the mainstream perspective. Most people are very unaware of the precious metals in general and even less aware of the potential in silver. We'll look at some of the longer term charts on another week. In summary, we're watching the support 1285 to 1306, the long-term resistance line, which is the big one, 1355 to 1378. I've said it for a number of months now, but I'll keep saying it until I see one of those trends break. Silver, watching the major support 1750 to 1850. It has already been hit once, so it is quite possible that the low has been put in for silver. And we are watching the critical resistance that I want to see taken out is 2025. And as a long-term investor, I think if you see this level taken out, silver will be more or less in the clear to begin the next stage of its advance. The gold stocks I'm not going to cover this week. I've had a number of requests because there's a lot of fear about what may happen in the broad stock market, and I myself maintain the possibility that the broad stock market may be setting up for a significant decline, although it could happen in real terms and not in nominal terms. However, we will look next week at how gold stocks behave in a stock market crash. if that were to happen, let's look at some examples from history of the way that these stocks can perform. I thank you very much for watching. The next update will be 1 week from today, during the first week in October on Wednesday evening. Have yourself a wonderful evening, and I will see you then.